At the precise moment of this analysis, Nvidia stock is trading live at $184.61, which is showing a subtle intraday decline relative to the opening flush, but holding firm within a highly compressed range. We are seeing the stock oscillate between a low of roughly $184.17 and a high of $186. The market is currently digesting a complex mix of geopolitical headlines and technical consolidation, and if you are watching the order book, you can see the hesitation. The volume is ticking over steadily, but it lacks the explosive directional conviction we saw just a few months ago. Here is the tension that is defining this specific trading session. The expectation among most retail investors and the headline readers is that the recent approval from the Trump administration to allow H200 chip sales to China should be an immediate green light for a massive rally. The logic is simple: more markets equal more revenue. However, the reality is significantly more nuanced and potentially treacherous. The market is not rallying on this news because the approval comes with a 25% tariff, and more importantly, a looming question about whether Chinese entities will even step up to buy these chips in volume given their own domestic push for self-sufficiency. The disconnect between good news on paper and the lukewarm price action on your screen is where the real story lies today. When we look at the last few hours of trading, we are witnessing a classic volatility contraction. The stock is tightly coiling. For those of you managing your own capital through an individual brokerage, this price action can be incredibly frustrating. It feels like the stock is stuck in mud, pinned near the $185 level. But seasoned traders know that this kind of tight consolidation often precedes a violent move. The institutional heavyweights are not aggressively buying the breakout, nor are they dumping shares. They are waiting. If you check your Fidelity mobile app or your interactive brokers platform, you might see that the bid-ask spreads are tight, but the depth of the order book suggests a standoff. The big desks are waiting to see if the $183 support level holds or if we flush down to test the $175 region. Let's strip away the noise and look at the actual mechanics of what is moving or stopping this stock right now. The biggest headline is the H200 export license. For months, the narrative was that Washington would completely choke off Nvidia's access to China. Now the door has cracked open, but it is not wide open. The 25% tariff essentially acts as a margin compressor or a price hike for the end customer, depending on who eats the cost. If Nvidia passes that cost on to Chinese tech giants like Alibaba or ByteDance, those companies have to decide if the performance gain of the H200 is worth the premium over domestic alternatives or the black market sourcing of restricted chips. There is also a fascinating subplot developing regarding smuggling and the use of banned chips. Reports are circulating that Chinese startup DeepSeek has been training models using Nvidia chips that they technically shouldn't have access to. This creates a strange paradox for the stock. On one hand, it proves the absolute necessity of Nvidia's hardware. Even banned entities will move heaven and earth to get it. On the other hand, it invites regulatory scrutiny. If the U.S. government decides that the current restrictions are too leaky, they could snap the leash tighter, negating the recent optimism about the H200 approvals. This is why you are seeing that hesitation in the price today. The market hates uncertainty, and right now the regulatory landscape is as foggy as it ever has been. While we analyze this, it is crucial to understand the broader sector context. Look at Tesla stock today. It often trades on pure sentiment and momentum, swinging wildly. Nvidia is trading more like a utility of the future. Its movements are becoming tethered to massive capital expenditure cycles rather than just retail hype. Compare this to Apple stock, which is acting as a defensive fortress. Nvidia sits in the middle. It is a growth stock that is maturing into a critical infrastructure play. If you are using a tool like Schwab Intelligent Portfolios or looking at how Fidelity mutual funds are positioned, you will likely see that Nvidia has become a core holding, almost a required weight in any serious portfolio. This structural buying provides a floor, but it also means that for the stock to double from here, we need more than just good earnings. We need a fundamental shift in the global economy's compute consumption. Let's talk about the flow of capital we are seeing today. Retail investors, perhaps those of you executing trades on the Robinhood app or checking your Robinhood stock trading accounts, have been consistent net buyers on dips. However, the institutional data, the smart capital, often routed through dark pools or visible on the Interactive Brokers trading dashboard, shows a distribution pattern. They are selling into the strength. When the stock pops to $186, the ask side loads up. This suggests that the big funds are taking profits and rotating. Where are they going? Some are moving into software, some are to broader industrials, and some are just raising cash. This brings us to a critical concept for anyone engaging in online investing or trying to manage self-investing strategies: the circular deal fear. You might have seen headlines about this. The worry is that Nvidia invests in cloud service providers, who then take that investment capital and use it to buy Nvidia chips. It creates a revenue loop that looks fantastic on a balance sheet, but raises questions about organic demand. Is the demand real, or is it funded by the vendor itself? While this is a common practice in Silicon Valley to seed ecosystems, when you're a multi-trillion-dollar company, the scrutiny is intense. If the market starts to believe that a significant chunk of revenue is essentially subsidized by Nvidia's own venture arm, the multiple compression could be severe. However, we have to contrast that bearish view with the industrial build-out thesis. Think about the railroads in the 19th century. There was a bubble, yes, but the railroads were real assets that transformed the economy. The bulls argue that we are in the early innings of a similar build-out for digital intelligence. If that is true, a P/E ratio of 45 or 50 is not just justifiable, it might be cheap. This is the debate you need to have in your head before you press the buy button on your SoFi Invest app or log into your Fidelity brokerage account. Are you buying a railroad tycoon in 1850, or are you buying a dot-com pet store in 1999? The answer likely lies somewhere in between, but the market is struggling to pin it down today. I want to pause here and ask you a question, because your sentiment is a better indicator than any chart I can draw. Comment below how many shares of Nvidia you currently hold, and more importantly, at what price would you be willing to double your position? Are you waiting for a crash to $150, or are you buying the breakout at $190? Now, let's look at the technicals on the daily chart. We are sitting right on top of the 50-day moving average. This is a key line in the sand. If we lose this level with volume, the next stop is the $170 area, which aligns with previous consolidation zones. If you are active in Interactive Brokers stock trading, you might be setting your stop losses just below $180 to avoid a liquidity cascade. Conversely, the resistance overhead is thick. The $200 level is a psychological barrier, but the real technical wall is around $195, where we failed to hold recently. For those of you who use investment help services or rely on robo-advisors like SoFi Robo-Advisor, you usually don't have to worry about these minute-to-minute gyrations. But for the active trader, this consolidation is a headache. It destroys option premiums. If you are holding calls expecting a massive pop, the time decay is eating you alive. This is why understanding the nature of the participant is key. The option market is pricing in a move, but the equity market is refusing to give it. Let's shift gears to the macro picture. The Federal Reserve's policy path remains the elephant in the room. High interest rates are generally bad for high-duration growth stocks, but Nvidia has so much cash and such high margins that it's somewhat insulated from the cost of capital. However, its customers are not. If startups and mid-size enterprises cannot borrow cheap capital to buy H100s or H200s, demand could soften at the edges. This is why you should keep an eye on the broader NASDAQ reaction to bond yields. Today, yields are kicking up slightly, which is another reason we are seeing this lid on the price. Furthermore, we need to discuss the competitive landscape. It is not just about Nvidia anymore. AMD is pushing hard, and custom silicon from the likes of Amazon and Google are eating into the easy wins. When you look at your investment, you have to ask, is Nvidia's moat shrinking? The CUDA software layer has been the defensive wall, effectively locking developers into the ecosystem. But with the rise of open-source models and alternative hardware, that lock-in is being chipped away. It hasn't crumbled, but the cracks are visible. This is why the H200 approval to China is so critical. It allows Nvidia to defend its market share in a region that is actively trying to design around them. If you are just starting your journey with online investing or using investing sites to research, it is easy to get lost in the hype. Nvidia is the future of AI is a great bumper sticker, but it is not an investment thesis. The thesis has to be about cash flow sustainability. Can Nvidia maintain 70% gross